The Bank of Canada makes no move on interest rates, much to the chagrin of variable rate mortgage holders. The big question on everyone's mind is if and when we might see another cut from the Bank of Canada. In today's video, I'll break down the latest announcement and what needs to happen for us to get one more rate cut. Let's start with what just happened. The Bank of Canada kept its key interest rate at 2.75%. And this might come as a bit of a surprise for anyone who follows the Canadian economy. Retail spending has slowed. Consumer confidence has dipped. Business optimism is falling, but it's not a collapse. The data at this time doesn't show a deep recession, just sluggish and uncertain. So, if the economy is clearly cooling down, why not offer some relief? The answer, in one word, is inflation. Yes, headline inflation has come down, but the bank's core inflation metrics are still above 3%. The real issue, services inflation like rent, restaurants, healthcare, is proving sticky. Economists at RBC say it's not the global shocks anymore, it's domestic prices, which are harder to tame. And Scotiabank says the bank is still fighting the last inflation fight. So even though economic cracks are showing, the bank is worried about doing too much too soon and letting inflation flare up again. There are also other risks that makes the bank nervous. Possible fiscal stimulus this fall, aka more government spending, global trade uncertainty, especially with the US, and still relatively strong employment numbers countrywide. The bottom line, the Bank of Canada is in a very tricky situation. They would likely like to cut in order to provide some help to the economy, but they worry about what's going to happen if inflation goes up if they cut too much too fast. With that being said, you're left wondering, when will the Bank of Canada have more rate cuts? Here's what the banks are saying. BMO still sees a cut possible this year, maybe even soon, but most economists are betting on just one more cut, max by year end, and RBC doesn't expect any further cuts at all in this cycle. The wild card remains inflation. If core inflation stays above 3%, the bank might have to stay higher for longer, even if consumers are hurting and growth is flat. The bank's not committing to a timeline. They're watching the data and holding. They will act if the numbers give them a reason to do so. So here's the bottom line. The Bank of Canada is hitting pause, not because everything is fine, but because they're trying to not make things worse. Rates are staying high for now. Mortgage renewals will still sting. Buyers still face the stress test challenges. But if inflation keeps cooling, there is a chance we could see some relief in the coming months. If you want to stay ahead of what's happening in the Canadian real estate market, hit the subscribe button and give this video a thumbs up. And as always, don't forget to leave a comment below with your thoughts and questions. And lastly, if you're planning to purchase, renew, or want to buy an investment property and want to understand your options in this environment, check the link in the description of this video to book a one-on-one call.